30-year mortgage is not a prison sentence. I know that it can feel that way for sure, right? You get trapped into this thing and it just seems like over and over and over again, you're paying this monthly payment and you're watching your mortgage balance change by what seems like dollars when every single month you're paying thousands of dollars, right? But what people don't understand is that we can flip that switch and learn the same ideas of compounding and turn that against the financial institutions. And it's not you being malicious either, it is just a strategy. The whole idea of the 30-year fixed mortgage is a format that benefits the banks and the financial institutions that are lending money. They don't make money by having you pay off your loan early. They make more money by having you take the entire 30-year term of that mortgage. It's literally just a strategy. Banks utilize time to maximize their profitability. It's just a strategy. It's a hack. So let's talk about what in fact a 30-year fixed mortgage is and why what we're going to talk about here today matters, because I'm going to go over some stuff right now that is going to be absolutely mind-blowing. Nobody talks about this. I don't see commercials about this. I see very few social media people out there with this. It's all about conforming to the standard of what we know, which is just like, hey, I'm going to pay this mortgage 360 months of my life, and at the end, I'll probably have a house that's free and clear. That's the way we think about things, but it doesn't have to be that way. So a 30-year fixed mortgage is not like, so let's use an example in this whole conversation of like a $500,000 mortgage, okay? We're gonna, and I'll just, we'll say at a 6.25% 30-year fixed interest rate. Okay, pretty standard loan that people today are getting. What financial institutions are not doing is taking this $500,000 and dividing it up equally over the next 30 years, and then once you're done, you pay it back. It's paid on what's called an amortization schedule. So every single month that you're making this mortgage payment, a portion of it is allocated towards principal pay down. So you actually see your mortgage balance go down a little bit, and a other portion of it goes to interest that is paid to the banks. But the way that the construct of the 30-year fixed mortgage works is that the banks primarily make their interest before you pay off the principal. So back to that example. On a $500,000 mortgage at 6.25% interest rate on a 30-year fix, you would be looking at a mortgage payment of $3,077. Let's just call it about $3,000, right? Now, that does not include taxes and insurance or HOAs or things like that. That's just the principal and interest component of a 30-year fixed loan, $500,000 at 6.25%. Now, of that $3,000 monthly payment that you're paying, only a small piece of that in the early part of the years is being applied towards lowering that $5,000 balance, and the rest of it is going into the bank's pocket as interest. Every single month that you progress along that 30-year fixed term, or which is 360 months, it starts skewing a little bit different. So less interest, more principal, less interest, more principal, less interest, more principal, so on and so forth throughout the entire lifetime of the loan. But here's the big gotcha moment, right? It takes approximately 15 and a half years before that $3,000 mortgage payment is even split equally, where 1,500 of it would go to interest and 1,500 would go to principal. 15 years, half the life of the loan before you start paying more to principal than to interest, right? So how do we hack that? Because I mean, it's so discouraging. I've worked with people for the last 20 years and my God, they call me a year or two after their mortgage and they're looking at their balance and they're like, dude, this is like barely $20,000 off of the principal of what I've borrowed and I've paid $80,000 out of my pocket, right? Like it's really insane how it works, but it's a strategy. It works well for the banks. So let's talk a little bit today on how we can hack that, flip the switch, and reverse this and play time in our favor instead of the bank's favor, okay? So look, we're going to talk about this idea of what we call positive amortization. So we're going to go back to this example here of a $500,000 mortgage at a 6.25% 30-year fixed interest rate that you got today. Okay, you're looking at a mortgage payment of $3,077 to cover the principal and interest portion of the mortgage payment. So what a lot of people don't realize, and maybe you've heard about it anecdotally or whatever, but I'm going to put some hard numbers in front of you. So if you pay the equivalent of one extra mortgage payment per year, so you can do that any way you want. You could take that $3,000 and every 6 months pay a $1,500 additional payment, or you could pay $250 a month. That equals about $3,000 extra per month. Or you can wait till the end of the year and just write an extra check for $3,000, and it accomplishes the same thing. That money gets applied to principal directly, because if you're paying more than the bank is asking you to pay or is requiring you to pay, you get to choose where that money is allocated. The bank does not get to choose. That means you can instruct the bank for every $250 extra that you pay each month, I want that to go directly toward principal. They cannot stop you from doing it. You absolutely can do it, and it's the biggest wealth building tool you will ever do. So instead of paying $3,077, if you added the extra $256 a month, you will have effectively saved yourself $120,000 of interest when you pay this mortgage off. And this is how it works, right? Because if you just take a regular standard paying the minimum payment to pay back that $500,000, you will pay an entire lump sum of $1,100,000. That's a scary number, right? But it's the truth, because again, bank makes all of their interest, and then as that starts going throughout the process, then you start paying down your principal. Now, by paying this one extra payment per year, lump sum, twice a year, broken up into 12 increments of $255. However you skin that cat, it doesn't matter. As long as by the end of that year, you have applied an additional approximate $3,000 towards the principal, you will cut off about 5 years off of the life of that mortgage. 5 years, right? So instead of paying it off 30 years from now, what is it? It's 2026. So instead of paying it off in 2056, you pay it off in 2051. Right? You will have saved yourself $120,000 in pure interest. Because once the principal's paid off, the bank can't continue charging you interest on that money. So, okay, Dave, well, that sounds really great, but I want more. How do we get more out of this? Okay, if we upped it to 1.5 extra mortgage payments per year, so instead of about $3,000 extra per year, about $4,500, or it's about $380 a month, okay, extra on your payment if you chose to do it monthly. Well, if you did that, you are now cutting about 8 years off of the loan. So you're paid off in 22 years, done deal. You now save yourself $170,000 of interest. So instead of that big 1.1 million out of pocket total, like cash dollars, you're left with, you're paying $935,000 of cash out of the pocket. Pure savings, $170,000, and debt-free on this mortgage 8 years early. Well, shoot, Dave, that sounds pretty good. What's the next step forward from that? And by the way, it can go on and on and on and on, right? But if you increase that to 2 extra payments per year, I get it. That's not a small amount of money, right? That's over $6,000 a year, which translates into just over $500 a month. That's not chump change. I get it. But look what you get as a result of that. The total out of pocket that you pay on that mortgage, compared to the 1.1 million that you would pay if you just carried out the natural order of that 30-year fixed, would go down to $895,000. You will have saved yourself over $200,000 of pure cash in hand that the bank is not getting in interest. But equally important is you pay off that loan 10 years earlier. So now, 20 years from now, You no longer have a mortgage payment to make, and you have saved yourself $215,000 that you did not have to pay the bank in interest. Guys, this is game-changing stuff. Of course, they're not going to educate you. Anybody who's bought a house before, if you're sitting here scratching your head on why there wasn't a form in that big stack of loan documents that educated you on this, like, duh, they don't make money by helping you pay off your loan fast. They make money by having you pay off your loan in the longest amount of time possible, because every single month they've got you on the hook, they get to collect interest. Now, it's important to remember a couple things here, right? Because paying these extra payments are way more effective on the front end of that loan. This is the time, that first 5, 6, 7, 8 years of that loan, where you're hardly paying any of the principal off. If you're doing it sort of the natural way, this is where you want to force the pay down of principal, right? By demanding that they apply that extra $200 or $300 or $400 directly towards principal. That's where you're going to get the biggest bang of your buck, because they're only going to be calculating the remaining principal or the remaining interest dependent on what's happening with your principal. So if you're banging down your principal balance on them, they may not like it, but they can't charge you as much interest because you don't owe them as much money. Guys, this is the biggest hack in town, but it's really critical that this process starts early on. If you start, because after 15 years, I told you 15 years is where that curve intersects, and now most of your mortgage payment then starts being applied towards principal instead of interest. If you start this model after that, your mortgage payment is already going primarily to the principal, right? The time to take advantage of this is in the initial first half of that mortgage, or even more important, the first 5 or 10 years, the first third of that 30-year term, because that's where the bank is really sticking it to you. It really is, because you're paying hardly anything off the principal balance of the loan. What I love about this model as well is it's like a guaranteed investment, right? If you were to do that, if you were to apply an extra $500 towards the mortgage, I get it, it's hard. Right now, affordability is tough, without doing that. But a lot of people out there, they have different mechanisms of investing that they're doing. They're putting some money into crypto. Maybe they have a 401k, they have an IRA. There's all sorts of other mechanisms outside of somebody's house that they're using to grow their, financial legacy and financial wealth. This should be part of it. This should absolutely be part of it, because it's just math. You don't have to worry about the stock market going up and down. You don't have to worry about inflation going up or inflation going down. You don't have to worry about politically who's sitting in the White House. It's guaranteed. It's a guaranteed return, because the loan is set on a set amortization for the next 360 months. So you can manipulate that as much or as little as you want. They don't want you to manipulate it at all. Right? They don't want you to manipulate it at all. They want to just do like standard operating process the entire time, so they can maximize the profit that they're going to make. So I love the fact that it's like a guaranteed return. But let's use like a case study, right? So we'll take a 35-year-old young family who decides, like, okay, renting is for the birds. I don't want to do that anymore. I want to buy a house. Okay, so we're talking about 35 years old. If they implemented this strategy, we're talking about at age 55 years old, you have now shed the largest financial obligation that most people have during their retirement years. And you do it 10 years before retiring. Right, you guys, I mean, this is incredible. What would that mean from a freedom aspect? How much earlier could you retire from your job instead of working till you're 70? Could you retire at 60 if your house is paid off in full already? I don't know. They say that housing expense and medical expense are the two biggest plagues on the retirement community against their assets. And if you have a big mortgage at the time you retire, you can't retire unless you have built, fixed income sources enough to be able to fuel your out of pocket. But this way you guarantee yourself. If you were to do this at 35 years old, you guarantee yourself a free and clear home in 20 years. Now, what could you do with that money that you were otherwise paying for a mortgage when you don't have to pay that mortgage payment anymore? How much more could you catch up on your retirement? How much more could you fuel your Roth IRAs? How much more real estate could you buy? I mean, I just told you you're going to save $215,000 in cash money, right? Think you could pick up another property or two with that money? You bet you can. And maybe throw a renter in there so they're paying your mortgage instead of you paying your mortgage. You guys, this is the ultimate hack. Real estate is being poo-pooed on right now. There's all these people that are saying, oh, it's cheaper to rent than to buy a house. What the hell? Let's use this as an example, okay? So we're gonna go back to this 35-year-old family that decided to get in on the mortgage that we've talked about here today. So they're gonna be paying about a little over $3,000 for the principal and interest portion of this. Let's say they chose not to do it. They chose not to do it at all. They chose instead to pay rent, okay? Pay rent. So they pay rent, let's say they pay $2,800, pretty reasonable. In fact, I'd like to find that house out there. I know a lot of people that are looking to rent at that price range that can't find anything. But let's say they started at $2,800 of rent. And over the next 20 years, they experienced a very conservative appreciation of rent or inflation of rent at 2% per year. Nationally, historically, it's higher than that. But like for the sake of this example, I just want to be super, super conservative. So 2% per year. And for all the naysayers out there that said, no, rent stayed the same this last year. Okay, maybe it did this last year, but prior to that, it went up 4%, right? We're not talking about a linear 2%. We're saying it's going to average 2% over the course of that 20-year period. You will be paying at the end of that 20-year term, you will have paid approximately $820,000 of cash money. If you did this example that we talked about of paying the extra $500 a month on that 30-year mortgage and killing that deal 10 years early, I told you you would have come out of pocket with a total of about $895,000. Well, so naturally, renting's cheaper, right, Dave? We paid $895,000 in order to pay off this mortgage, but we only paid $820,000 to rent at this place. Wrong. Like, seriously, think about that, right? Because if you rented at the end of paying that $820,000, what do you got? You got nothing except next month's rent to pay. If, alternatively, you bought the house, let's say you bought this house at $500,000 today, assuming it went up on, again, the conservative end of historic appreciation for homes of 3% per year, that house would now be worth over $1.1 million. So it's very narrow-minded to compare cash out of pocket of $820,000 versus cash out of pocket of $895,000. Well, clearly the $820,000 is a lower number, so it's cheaper. Baloney, because what you get out of the sacrifice of paying that additional money out of pocket is a $1.1 million asset owned free and clear. Congratulations, you're a millionaire. Did you know that there is no other vehicle in the United States that creates more millionaires than through the vehicle of real estate? It's not being a social media influencer. It's not being a crypto king or hitting a jackpot on a good IPO. Those are exaggerations and they're unicorns out there. More people become millionaires in America through the vehicle of real estate, hands down, not even a close second place to it. So I keep seeing all these trolling social media people out there. Oh, it's cheaper to rent. You want the flexibility of being able to move here or move there without being tied down to this mortgage. You know what? I'll take that flexibility when I'm 55 years old without a mortgage, where I can go travel the world and help my children and do whatever I want at that time, instead of in those later years being strapped down because I got to pay a $4,000 rent payment, which is what that rent will be, by the way. That $2,800 rent that you're paying today, assuming that 2% inflation of rent per year at the end of 20 years will be over $4,000 a month. It will catch up and it will surpass whatever your locked in 30-year fixed minimum payment is on the mortgage. Guys, it's just a financial lie to think about it otherwise, right? I mean, it's such an important vehicle here. So I wanted to present these numbers to you guys. And what I love about this is that it doesn't require you to do anything. You don't have to refinance your mortgage to do this. You know, there's a lot of people that are saying, well, I'm going to wait until rates go lower, and then that's when I'm going to jump into the housing market. You ask that of the people that tried to go buy homes when interest rates were at 3%. It was a bloodbath out there. The demand was so crazy that people kept bidding and bidding and bidding and bidding and bidding at each other out. Not just on the price of the home, where they were paying literally hundreds, sometimes of thousands of dollars more than the house was worth. True story. I sold a house in 2021. This is an honest to goodness story. I sold a house in 2021. Because of the nature of what I do, I know a lot of real estate appraisers, as you might expect. So I called a bunch of them up and I said, look, I want to know the highest price that this house can be appraised for from a value standpoint, right? So 3 different appraisers, 3 different people gave me a different answer to that. Right? All within the same sort of general area. But me, like any other seller, I chose the highest one and I said, winner, winner, chicken dinner. So that is the price that I listed my home for. Okay? Put it on the market. I'm not going to say how much because it doesn't matter. I put it on the market for that amount within 4 days. This was February 2021. Within 4 days of having this house listed, I had 19 offers of people that wanted to buy that house. I ultimately sold it to somebody that paid $90,000 more than I had listed it for. And I had listed it for the highest amount that 3 different appraisers told me it was worth. 90,000. And I remember I called the buyer's lender when we were vetting out different offers. And I said, hey, dude, I'm not a civilian, man. I do what you do. Like, walk me through this, because like, how are they going to do this? The house is not going to appraise at what you guys are writing this for. And he said, Dave, I know who you are. Totally understand, but they don't care, because they just sold their house over here in a competing neighborhood down the road from us, and somebody had paid them $110,000 more than they were selling the house for. 110,000. So as far as they were concerned, they were plus 20,000. They got 110,000 more than their house was worth, and they gave me $90,000 more than my house was worth. They're still in the money by $20,000. And that was the kind of business that was being handled when rates were low, right? That was a terrible time for homeowners to purchase homes, you guys. Now, granted, there are some people that are locked into some wonderful mortgages that we'll probably never see again, right? Unless we like do some sort of repeat on a pandemic, God help us. So like, you know, you're gonna be waiting a long time if you're waiting for that environment to come back. But there is an element that you should understand. Everything that we just talked about here today, a refinance in the future, if and when rates get better, which I believe they will. I think we're over that hump and we're expecting sort of a calmer seas ahead of us over the next 3 to 4 years. I mean, all the statistics, all the forecasts, National Association of Realtors, Mortgage Bankers Association, Freddie Mac, Fannie Mae, anybody who's sort of in the industry of the cost of money is all projecting lower interest rates in the future. I mean, you're hearing it all day long. You don't have to take my word from it, right? Even the Federal Reserve has finally jumped on that bandwagon, and they're starting to make adjustments on their side of what their interest rate market controls. But if in fact rates get better in the future, you can, what we just talked about here today, you can absolutely amplify the benefits of it by lowering that baseline number. And because we're able to lower your payment from $3,077 to $2,800 just because the world's interest rates have gotten better, but you continue to keep paying the same payment you have, you'll crush that loan in less than 15 years by far. But here's the big hack you got to be aware of, like the refinance, where you reset the term of the loan back to 30 years. You're just restarting the cycle again for the banks. That's why they want to refinance you, right? Let's get you paid off 8 years of that mortgage. You only have 22 years. They sit in a boardroom and they say, God, how do we get John over here? We love him. He's a great borrower. We don't want to be done with him in 22 years. Well, hell, let's offer him a refinance and reset the term to 30 years again. Crazy, right? But did you know that when you refinance, you can stipulate to the lender that you don't want another 30-year. You'll take the lower interest rate, but you want a 22-year loan. You want a 26-year loan. You want a 23-year loan. You literally have the flexibility of amortizing the loan however you want, right? So I always encourage people when they're in a refinance situation to like take advantage of the lower interest. Of course you should, but don't deviate from this house hacking plan that I talked to them about. You guys, I've had consumers that have paid their mortgage off in in 12 years, 13 years, 14 years. And it's incredible. And this is truly the beginning of generational wealth, right? Don't be surprised why banks aren't teaching you this. Use a little logic, use a little brain power here, right? They're not trying to get rid of you. They want to keep you. So they're not going to teach you how to pay your mortgage off sooner. This is an absolute house hack, and I love it because you could be on this, right? And say, okay, Dave, I'm committed. $500 more per month. I'm going to do it. I'm going to go for the gusto, right? We're ready to roll. And maybe the first year of the loan, you can't do that. You just simply cannot, right? You just don't have enough monthly cash flow to be comfortable at home. That's okay. You can start it in year 2 after you get a 4% raise at work, and you guys are making more money, or you get a promotion or whatever. There's no mandate. You're not locking yourself into having to pay more per month. So I love the flexibility. What other investment in the world allows you to just guarantee your return, but not require you to be committed to a contribution? So January, you pay $500 more. February, March, April, it's just dialed in, right? Then, little junior needs braces. These are things that just happen in life, right? The car broke down. We need new tires. We need whatever. So just don't pay the extra $500 that month. You can either catch up on it later in the year or just don't. You can get back on this pathway at any time. Now, I'd strongly encourage you to get back on as quick as you can make that happen, because again, it's those initial months, right? It's the first 5, 6, 7 years of that loan where you get the most bang for your buck by paying this principal down. So you don't want to miss that opportunity to do it. But at the same time, right, you have the flexibility to deal with life events that happen. Nobody's going to come and knock on your door and say, "Hey, where's that extra $500?" And they're not going to reach out to you and say, "Hey, I noticed your mortgage payment, like you're paying less." No, why? Because they don't want you to pay more. They want you to just pay the minimum payment because they want to keep you around as long as possible. I don't know about you guys. Debt-free on the biggest financial drain 20 years from now and sitting on over $1 million of assets. If you're a potential first-time home buyer out there that's considering whether they should get into the market, yeah, it's tough. I get it. It's hard to be affordable. But you know what? Things that yield the greatest results in life are tough. Tough shit, right? Homeownership is not for everybody. It is what it is. Don't shoot the messenger. But for those people that believe in what we talked about here today, maybe they've experienced it generationally in their family, it is history changing, the kind of wealth and legacy that real estate builds. Think of what you could do 20 years from now without a house payment and $1 million plus asset. And that's getting into a home approximately $500,000 today, which is achievable. It's out there. For first-time home buyers, it represents a great entry point, right? Or lower or higher, wherever you are, different strokes for different folks. It works the same for everybody. To not know this is a travesty, right? If you don't want to do it, if you get a mortgage and you don't want to do it and you just want to be a customer for 30 years of your life, rock and roll, dude. No, I'm not here to tell you you're wrong. What I'm saying is wrong is to not know this. That's not okay. And this industry should be putting this on the forefront instead of burying it in the back. I highly encourage you to consider that if you're considering buying a mortgage, and there's so many other ways to hack also. If there's things like, there's people who pay PMI on their mortgage longer than they have to. It's just wasted money. Like there's all sorts of ways to reverse the script on the financial institutions that created this model, not for you. It's for them and for shareholders. That's who benefits from the model, the way it's set up, and good for them. Where else are you going to get the $500,000, right? We have to play ball, but that doesn't mean we can't have a strategy of our own. And it's okay. They're not going to be mad at you if you do this, right? Because for 1,000 customers that they may have, maybe a few of them know this and do this. So they'll just go ahead and make the bank on the other ones. It's like credit cards, right? So credit card interest rates right now are insane. Even I have perfect credit. My credit card interest rates have climbed like crazy. I don't pay $1 of interest. I use the heck out of my credit cards because I've flown my family around the entire world on Alaska's dime, right? On Bank of America's dime. Because I don't pay a dime of interest because I pay my full balance before the end of the month. Are they mad at me? They keep increasing my limit, in fact, over and over. And other credit card companies are trying to get me in there. They're just praying for the day that I let a balance roll over. I think that's what I think about it. But the reason it doesn't impact them to pay for my family to go around the world for free is because the other 999 of 1,000 people are paying the minimum payment. And they're never getting out of that debt. And they're paying perpetual interest rate forever until they BK or somebody gives them money. I don't know, the different ways that people get out of credit card debt. It's really insane, you guys. We have to flip the switch. We have to turn the tables. And there's nothing wrong with us having a strategy the same way that they have a strategy. If you guys like what we talked about here today, if you want to talk more about PMI, other ways to hack your mortgage, other ways to sort of beat the system, or just if you want to know more about what this world of real estate financing has to offer, you got to check it out. Shoot me a message. Go to our website, takecontrolre.com or elevategroup.com. I'll put all that stuff in the description below. And I'd love to chat with you. We do this amazing live webinar. In fact, it's almost like a boot camp, right? Like we do it live every couple of weeks, and it's very current. We're talking about current state of affairs. We're tracking trends of interest rates and home prices and things like that. And the whole thing is just designed to put you in the driver's seat, man. It's just, we call it the Empower Hour because that's exactly what we're doing. We're just trying to like lift this veil off of people that are generally doing this blindly. It's just crazy that more people will spend more time deciding where you're going to go to dinner this Saturday night and who you're going to invite to that party than in preparing for the largest financial decision they're ever going to make in their life. It is insane. Don't be insane. That's the advice for today. Thanks a lot, guys.